Hello traders and welcome back to my channel. If you're new here, my name is Emily and I have been day trading the Forex markets for over 5 years now, trading both my live account and a fully funded prop account with the prop firm The 5%ers. In this video today, I'm going to share with you a lesson on market psychology. This is taken from my course Mindset Mastery for Traders. If you want full details about the course, there is a link in the description below as well as a free mini course Mindset Edge. But we're going to be looking at market psychology, understanding how this can help us to improve our trading performance. We're going to be looking at some common trading emotions as well as how to gain an insight to the current trend in the markets as to whether it is fear-based or greed-based. So before we dive into this lesson, please remember to like and subscribe to the channel and let's get straight to it. Here is lesson 2 from the first module from the Mindset Mastery for Traders program, Understanding Market Psychology. First of all, what is market psychology? Collective emotions, behaviors, and decisions influencing the markets. The markets are shaped by human psychology beyond fundamentals and technicals. So basically the markets, what we see on the charts, the movement, the candlesticks, that is just a visual representation of human psychology, what we think that asset is worth. It goes up when we think it is worth more, and it goes down when we think it is worth less. And certain aspects like the fundamentals and technicals obviously influence that movement, but the movement it's all about psychology and what we think. So why is it important to understand market psychology in the first place? Well, it helps us to predict the market moves before they happen, which obviously this is a large part of trading and how we can capitalize on those moves. It helps us to identify fear and greed driving price action. This is really important because you don't want to be brought in by those emotions. You don't want to be influenced by fear and greed, join in that rush, that panic, that emotional trading that other people are doing. And also, it helps us to identify if a market is going through a period of emotion and it may be best to sit out of trading in that situation. Avoid emotional trading and stay rational, very important. And following smart money, not the emotional crowd. So you don't want to be roped in by the emotions because quite often that will lead to unnecessary losers. Crowd behavior and market sentiment. Herd mentality drives mass buying and selling, often poorly timed. For example, Bitcoin's $60,000 surge was FOMO buying, and the $20,000 crash brought in panic selling. Whereas smart money would buy during that crowd fear, it would wait for that drop and then buy in at a better price, rather than panicking and selling and getting out quickly. Just being aware of how the emotions can affect the movements in this way. So when I'm talking about market sentiment, what exactly is that? The market sentiment, it's the feeling, it's the overall mood of the traders. We often refer to it as bullish, or another word would be optimistic. People think it's going to go up, or bearish. They think it's going to go down. They're quite pessimistic about the forecast. Signs of greed can often bring in parabolic price moves. What is a parabolic price move? That's where it forms a really, really strong up candlestick. I'm not talking about a bullish engulfing. I'm talking about a complete momentum candlestick. It's parabolic. That's high volume. It's often over evaluation. It's greed. It's emotional. And if I see that on a price chart, often I will sit out of that, wait for the dust to settle before I get in for a trade. Another version of that for signs of fear are sharp drops. So that might be parabolic as well, but to the downside, because people are afraid, they're selling, they're getting out quick, it's volatile, there's a very high demand for the safe havens. And again, it's just being aware of that influence in the markets. So how do we actually measure market sentiment? You can see them, you can see patterns of it on the charts from very, very large candlesticks, but you can also refer to some tools to help you. I'm talking about the Fear and Greed Index on CNN. There's market volume and volatility indicators you can look at, and obviously there are news and social media impacts, but they're not a very solid method to use. I like to use the Fear and Greed Index from CNN. So let's talk about that a little bit more. That measures if a market is driven by fear or greed. Extreme fear will often provide the buying opportunities, and extreme greed potential selling points, because if people are being extremely greedy and it's going up quickly, then that can give you good points for selling, looking at reversals. This can also help to avoid emotional trading. So I'll just look at the scale and then I will load up the fear and greed index for you. But basically it is a scale from 0 to 100, 0 to 24 being extreme fear, goes up to fear, neutral, greed, extreme greed. So let's load that up now. I've just done a search in Google for the Fear and Greed Index CNM. It loads up the web page just so you can see how I got there. And it's very simple. This is the scale at the moment. As I'm recording this, it is Saturday, the 7th of June. It's just been a very choppy week for day trading Forex. We've had NFP. And at the moment, we are slipping into greed. Not long ago, for the stock market, we were in the fear zones, but we seem to be pulling back up, and now we're getting into the greed zones. So it's not extreme greed. It doesn't feel like we're at that highest point, but it's getting there. People are starting to get greedy because the market is moving up. And it explains it a little bit more if you scroll down. This is based on the S&P 500, so it's the 500 top US stocks in the US stock market. And this is what I mean. When it was down at this point where we were having this pullback on the daily time frame, this was when we were slipping into extreme fear mode because people were afraid because it's dropping. But it's usually at these peaks at the bottom when if we're in the fear mode where smart money would buy, because it makes sense to buy at the lows. Vice versa, now we are pushing up. It's getting greedy, but it's not an extreme greed. So if I was looking to day trade the S&P, I'd probably still be looking for longs. But when it starts to get extended and we get into extreme greed, it may be leading to another pullback. I've been trading with the prop firm, the 5%ers, for some time now. As a prop firm, they are a great option if you want to trade a larger capital, where you can trade one of their account sizes and you both take a share of any profits that are made. But they don't stop there. As well as offering account sizes for trading, they also offer these extra features, including live trading room, free webinars and workshops, and one-on-one performance coaching. They have 3 different programs that they offer to traders: the Hypergrowth, High Stakes and Bootcamp program. I'm currently funded with the Hypergrowth program, so I am trading that live account with the 5%ers and taking a split of profits that are made. And I'm currently enrolled in the High Stakes program challenge as well. And my favorite feature of the programs that the 5%ers offer that differ from any other prop firm out there is the fact that they have removed the time limit, which means that you have an unlimited amount of time to pass the program. This is a massive game changer, and it can really help you to avoid falling into a stressful situation when you're trading. Let's face it, trading can be stressful enough. If you want some more information, or if you're ready to have a go for yourself, do check out the link below in the description. So continuing on with the presentation, factors influencing the Fear and Greed Index. So we spoke about this a little bit before, but markets volatility, stock price momentum, put-call ratio if you trade options. Personally, I don't trade options. Markets volume, safe haven demand, stock breadth, and junk bond demand. So there's a lot of different things that can influence the Fear and the Greed Index. Personally, I find that it largely reacts to a lot of the currency data being released, interest rates and the relationships with the banks, as well as global news. Using the Fear and Greed Index, so as I said before when we were on the web page, you can identify market extremes for trade decisions, avoid FOMO during the greed spike. So at the moment we are at greed, but it's probably still opportunities for buys. It's when it gets into extreme greed and gets very extended that I would be reluctant, because you don't want to slip into FOMO. Always combine it with technical and fundamental analysis for confirmation. So you don't want to just look at this scale, the Fear and Greed Index, and think, okay, I'll buy in here. You've got to match it up with your plan. I'm not obviously saying to take this away and trade this, but it's just something you can use to help you to decipher whether you're slipping into emotional trading. If you're looking at a chart and you're thinking, wow, it's really high, I better get in quick, you can always refer to this. And if there's extreme greed, then it might just remind you that you may be getting greedy and it might be a good time to just step back. So another example with the Fear and the Greed Index was during the COVID crash. If you remember that, I was trading Forex at that time, March 2020. I remember everything dropped. There was extreme fear. And that was when a lot of investors bought stocks. It had a massive opportunity because everything was discounted. It was so low. So you could buy things for cheap. The market rebounded very quickly after that. And ultimately, a lot of people made money. At the time, I think I was just capitalizing on scalping the drops, shorting. As I said before, you can go to the CNN Business and Fear and Greed Index page on their website. Or there are other platforms like TradingView that have very similar sentiment data. So now I'm going to talk about another tool that you can use. I've not used this a lot, but I have used it in the past, the VIX. This is a volatility index. And this is very useful, again, to see, but this is displayed on price charts. And it shows you fear and panic in the markets compared with more calm trading. So the fear gauge measures expected 30-day market volatility based on the S&P 500. If it's greater than 30, it's looking to be fearful and panicked. And if it's below 15, it can be calmer. Again, let's load up the price charts and have a look at this. So I just loaded up TradingView, and you can see here VIX, VIX, that's the ticker, the volatility for the S&P 500 index. It's very similar to the fear and greed index, but it doesn't really show greed. It shows more the fear and then calm trading. So it's kind of like an inverse to the S&P. Just look at this pattern for a moment. Okay, we're kind of consolidating. We had this huge peak up and then a very sharp drop back down. So it went up to 60. Remember that if it's above 30, there's extreme fear. And then it came back down to 16 underneath 30 where it's calmer for trading. Now if I go to the S&P and load this up, the VIX, it's kind of an inverse to the S&P. So the S&P, at the same point in time as the VIX, the S&P dropped very sharply. And that drop in the S&P made a lot of people afraid. They were afraid because price was dropping. A lot of investors got panicky because they're losing money. And that made the fear go up in our psychology, which is the inverse of the VIX. So let me go back to the VIX. So that drop in the S&P was shown here on the VIX in the fear factor. But now the S&P is recovering, so is the VIX. It's come back down again. So it's another tool that we can use to help visualize the fear that's going on in the markets. So at the moment, the VIX was trading at 16. So it's kind of getting to a calm level. It's just above this 15 bracket. But I would say that it's a much calmer level than the way it was before. How do we use the VIX in trading? Well, a rising VIX increases fear and selling pressure, and a falling VIX means it can be a calmer market or maybe even greedy. So when it gets below that 15 level, it's a calmer market, but that's when people could slip into greed because everything's going up. At the moment, it's at 16. It's just above that calm level, which means that it's probably still a safe bet to be buying and going in line with the overall market. VIX ETFs, ETNs for volatility speculation. So again, just to help you to gauge the volatility before you decide to buy into those. And it's a contrarian indicator. Buy when the VIX spikes due to fear. So if the VIX spikes, people are afraid that the SPX is probably going to go down. So when the VIX is spiking up, that could be a good place to look for a buy. But of course, it's important to always match up this with technical and fundamental analysis. Practical steps trading with the Fear and Greed Index and the VIX. Once again, to recap, so check the index or the volatility before trading to help to confirm your bias. Identify any emotional extremes. So if there is extreme greed in the fear of an index and if the VIX is very low, you don't want to be slipping into FOMO. Look for technical and fundamental confirmations and trade based on rational decisions. There's another tool that we can use, and this is for gauging the strength of the US dollar. The US dollar index is called the DXY, the DXY, measures the USD strength versus a basket of 6 major currencies. So it's a tool that we can use on the price charts. It's a chart we can load up to look at the DXY, and it's the US against these currencies: the euro, the Japanese yen, the pound, the Canadian dollar, the SEK, and the Swiss franc. So the US dollar index, I've got it on the daily here, and at the moment it has been coming down for some time. It looks like it may be bottoming out here because we have not broken this low. Again, it's a technical chart. You can look at this price chart to get an idea. At the moment, it's quite low, which is the inverse to other currency pairs in the Forex market. So, for example, we look at pound dollar is up. We look at Australian dollar, it's up. Euro dollar, dollar yen will probably be down because the Dixie was low. So, at the moment, the US dollar is looking quite weak. But this could be a useful tool because if it starts to push up here, that could indicate the dollar is gaining strength. And it's another factor to take into consideration when you are analysing the other currency pairs, to know that if the dollar is gaining strength, then maybe it's not the time to go long pound dollar. Just to confirm, with the Dixie, a rising Dixie indicates US dollar strength and a falling Dixie indicates US dollar weakness. It influences currency pairs, commodities, and global sentiment. So why does the Dixie matter in trading? It can reflect global confidence in the US dollar. Affects currency pairs. If you're a Forex trader like me, it's definitely a useful tool to consider, but you can also use it for other assets, for looking at gold, oil, and for looking at indexes. It influences commodity prices and it indicates risk sentiment. So how would you trade with the Dixie? I mean, you cannot trade the Dixie directly, but you can use it as a tool to help you with your technical analysis for trading other assets. So you can monitor the US economic data and the Fed policies. Interest rate changes affect the US dollar strength, so the fundamentals are important. Use the Dixie movements to trade currency pairs and commodities. So if you have your fundamental news, you've looked at the economic data and you're looking at the Dixie, which is kind of like an overall technical view of the markets, it can help you to make a decision as to whether to go long or short on a pair with the US dollar. For example, long US dollar pairs on a rising Dixie, short USD pairs on a falling Dixie. If the Dixie is rising, the US dollar is getting strong. If you're looking at US dollar versus the yen, it's a good time to buy. So a summary of the points we've covered in this lesson on market psychology. Sentiment indicators help to gauge the market's mood and psychology. Fear and greed drive the market extremes. Combine sentiment with technical and fundamental analysis. It's always important to have that as confluence. Don't trade purely off the fear and the greed index or off the Dixie. They're just tools that you can utilize to help you in making your trading decisions in addition to other tools. Use the fear and greed index, the VIX, the volatility index, and the Dixie for US dollar strength as part of your trading toolkit. That concludes lesson 2 from the first module from the Mindset Mastery for Traders program. If you'd like to find out some more, there is a link below in the description where you can get some more information about Mindset Mastery, or there's also a link to a free mini course, Mindset Edge, if you want to check that out. If you've enjoyed this or if you've got any questions, do leave them in the comments below. Please remember to like and subscribe to the channel, and I'll catch you in my next video. Thank you for watching. Bye.